Hi guys, welcome to the daily charts. In this video we want to discuss one of the most important topics for traders, swing traders and day traders, which is the right strategy to implement. And the right strategy to implement derives first of all from your way of trading, your basically strategy. Are you trading 3 to 4 hours per day as a day trader, or you want to spend only 30 minutes per day as a swing trader, or only over the weekend? So in this case the focus is going to be on more work, analyzing a list of trading opportunities each day, and if it fits you, this strategy can be a winning strategy. It creates a lot of trading opportunity. It derives from liquidity of stocks. We use the trend, intraday trend in this case. We use technical entries, and we use the most important factor here is to take the low risk trade. So let's get right into it. Let's discuss first shorts, a list of shorts. Yesterday it was November 7th. So on my list, and you'll see immediately the parameters for this list, there are, as you can see, 11 matches. So there are 11 matches, and the idea here is that you don't want to over trade. Okay, so out of those 11, sometimes there will be on the list 15, sometimes only 5. You want to pick the best of the best. The idea is not to trade a lot. The idea is to trade the high quality trades, and immediately you'll see what I mean. So but first of all, how do you derive from this to this list out of thousands of stocks? So most of the stocks are obviously going to be stocks that reported earnings. Obviously those stocks are after terrible earnings, and again the idea here is the stock price is above $10, volume is in at least 6 million shares, which is okay. I mean, we don't want 20 million shares, but we don't want to trade anything that's 1 million shares or below. The percentage change in this case is 6% to be on this list. And again, if there are too many, you increase the parameters. If there are too few, you decrease the parameter. And the intraday trading range is 6%. That's actually the most important parameter. And what does it mean, 6%? If the price of the stock is $10, it moves at least 60 cents from highs to lows. If the price of the stock is $100, it moves $6 intraday, and this is where we make our money on the intraday move. So that's super important to us, this number, the intraday range. Okay, so we have here PRMB, Primo Brands. As you can see, it's down 18%. Traded yesterday, let's see, 52 million shares. Sunrun traded 25 million shares. STNE traded 18 million shares. FINV 12 million, and so forth. So we have no problem. The liquidity is plain and simple amazing. Now that we know what we want to trade off this list, keep in mind, during the trading day, this list is dynamic. There are stocks that are coming into this list, others are leaving the list based on the criteria that we just talked about. But the idea here is that you're gonna fix and try to work on the worst. So if we want to short, let's go and check out the worst performer yesterday, which was PRMB. Let's take a look at the intraday chart. This is the 3-minute resolution, as you can see, 3 minutes. And now let's take a look. This is the chart. So the stock basically, as you can see here, starts very weak from the open, trades lower, and then continues to trade lower pretty much throughout the trading day. So now the idea here is, okay, you observe the stock, it's on your watch list. Where do you trade it, and how do you trade it? So let me give you an example. PRMB, in this case, I'm looking at this breakdown. As you can see, under 16 here, the timing is 11 pretty much. So if I'm shorting it at 16, the risk will be, guess what, 20 cents. So 20 cents is roughly 1% of risk. So let's say I'm shorting here a position of $20,000. Let's round things up, so it's like 1,200 shares. The risk is 20 cents, 200 and $40 of risk. If I'm not okay with this risk, and I can trade instead of 1200 shares 600 shares or 400 shares. So the idea here is this, being that we're trading the most liquid stocks, okay, it's scalable. One thing that I need to also talk about, not all the stocks on the list are going to be shortable. Sometimes the broker won't have shorts, sometimes the shorts won't execute. But the idea here is, if you trade stocks that are very liquid, the shorts will execute most of the time. So in this case, you can clearly see this very, very little risk on the trade here, anywhere between 16 and 16.20, and the stock drops $1.50. So we risk 20 cents on the trade to get 150 cents. That's a 1 to 7 risk reward. Now, when the reward is over 1 to 3 or 1 over 3, that's great. That's V. So if we're getting 1 over 7, meaning we risk 1 unit and the reward is 7 units, that's beautiful. And if we're lucky, we're going to get you're going to see, if you apply this strategy, at times you're going to get 1 to 10, maybe 1 to 15. It's not going to happen very often. But 1 to 3, 1 to 5, 1 to 7, it's going to happen. And the idea here is that you can repeat this strategy 3 times a day, 5 times a day, 12 times again, depends on your aggressiveness, your willingness to spend time in front of the charts, obviously the trading opportunities, the market. So it varies, but I have no doubt, I mean, on average, anyone that is following this strategy can easily trade, okay, trade, not necessarily win, anywhere between 3 and 6 positions per day. And if you have one position that delivers above 5%, and the rest of the trades on average deliver nothing, you're still coming up if you have a big enough position with a very nice payout. Okay, let's see another example. It will get clearer, I hope, and then we'll go and move to long trades. So let's take a look. Let's pick the second stock, Sunrun. So what's going on in Sunrun? The same strategy. You can see a huge gap down. So the stock is immediately on our watch list. Now, but how does this Sunrun trade? It's basically trading sideways for nearly 3 hours before dropping. So let's say you wait, you don't do anything, and again, you want to go with the strategy, which is when the stock is down, you short it. When the stock is up, you buy it. Unless there's a clear trend. And then you need to go with the intraday trend. So again, right now we don't have a trend, then it breaks the support level and we want to short it. So it breaks under 1680, goes down 80 cents and reverses. Okay, so in this case, what happens? You short it at the red line. It comes down and V-shapes up, you exit at the entry. So no harm, no foul, because again, when the stock is more than 1% in the money, you lower your stop loss, in this case, to the entry. So you create a no loss strategy. And again, the concept is, if you take the mentorship, you'll understand that the concept is add more low risk trades and turn those low risk trades into no risk trades. So if you have at one point 3 low risk trades running and all of them are turning into no risk trades, and you add another 2 or 3, at one point you have 5 stocks working for you at no risk, and eventually 3 or 2 will end up back at the entry, and 1 or 2 will be big winners. One will be a 5% winner, one will be a 7% winner. That's a 12% winner on your position, which stays the same throughout the trading day. So if your position is at $10,000 or $20,000, that's your own business. But anyway you look at it, 10% on a small position or 10% on a bigger position, it's still 10% intraday. That's a lot. Okay, so that's basically a stock that let's write it out, even if we trade it. Let's take a look at stock number 4, number 5 on the list. Now, why I'm pointing to this stock? Because this one actually is doing the opposite of the strategy. The strategy is we want to short weakness, and in this case we have a stock that gapped down a lot, but it's moving higher. Now basically it's not something that we want to deal with, unless, again, and it goes with experience, you can find that you're sure that the trend is higher and you can find a low risk entry trade. Now if you can find it, do the trade. Okay, so if the risk on a breakout over 64 is in this case 50 cents, which is less than 1%, by all means, in this case it delivers $2.50 before pulling back. But the idea here is that we want to be consistent. So we want a short weakness and we want to buy strength. So this one does not apply basically to our strategy. Let's go to another example, and then let's move to the long plays. Let's see FIVN. So what's going on here? Another stock that basically it's trending lower at the beginning of the trading day. At one point you can observe this support level here. Let's call it 1930. So if you want to short the red line here, okay, the stop loss will be over 1960. Do you want to take the 2% risk here? That's 2%. It's way above our threshold, which is 1 to maximum 2. So most of the time we will prefer to trade a stock which carries only 1% of risk. So let's say you want to do it. Okay, so you short it and the stock drops from over 19 to under 18. And in this case it also comes back up to the entry, and there is no gain. So it shows you that there are winners, but the idea here is to stay with the trade and until that's my strategy that I'm teaching, to stay with the trade until the end of the trading day, because if you want to reach 10% intraday, it takes a lot of time. You cannot wait in a trade an hour and it's going to make 10%. Most of the time it will take 2 hours, 3 hours, sometimes more. So you have to let the trade run its course. Sometimes you're going to leave money on the table. That's the price of using this strategy. Now let's take a look at the long ideas. The same strategy applies, obviously. So we're looking at stocks that delivered mainly gap ups on earnings. Let's take a look at the biggest winners, starting with we have here on the list, hold on a second guys, we have JFrog. As you can see here, it's up 26%, TNDM up 21%, EOS up 19%, and so forth. Basically a huge list of winners. Now again, this list is based on our assumption that we want to trade stocks that are over 9%, volume is over 5 million, the intraday trading range is 10%, and the stock price is over $10. Now again, if I want to, there are 14 matches here on the list. Let's say that it's too much for me. I will increase the percentage change from 9 to, let's say, 12. And you can see I have only now 12 matches, or the volume from 5 million to 7 million. And now I have only 8 matches. So again, if I have less time to trade, or my strategy is to take less trades for whatever reason, or work just 2 to 3 hours per day, keep in mind that this strategy does not apply to the first hour of trading, because it takes time to develop first this list and then technical patterns. So the gap up, and those who are looking for a trade or a strategy which is a gap up and go, that's not the idea here. We're looking more at reversal strategies, VWAP strategy, cup and handle strategies, but not necessarily trades at the beginning of the trade. But again, okay, so I have only 8 matches on the list. Let's start with number 1, JFrog. And you can clearly see now again the same scenario. Huge gap up. Hold on a second, guys, my mistake. Huge gap up, and now my work, or our work, is going to be only one thing. Being that we have the pattern, where is the entry point? So the entry point is clearly not a breakout. That's not my strategy. It will be a pullback. So a pullback to the VWAP, an entry point. A pullback, a small pullback, another entry point. Small pullback, another entry point. Again, that's the strategy that I'm trying to implement and trying to teach. Do not buy breakouts look for the pullbacks, and if the pullback is at the VWAP, that's a V, and if the pullback is to a round number and it stays there 10-20 minutes so you can access it, it's a winner as well. But let's say if it is a V-shaped reversal, you cannot trade it because it comes down and moves up higher. But if the reversal is like a, let's call it base reversal at a round number, so you know that you can buy, let's say at 53 is the support level, and you can buy at 53.40 or 50 or 20, and you can use the 53 as stop loss. That is basically the strategy that we're gunning for. Let's see another example. Okay, this one is too tough to trade because there are no pullbacks. Let's try TGX. Okay, another great example. So what's going on here? The stock is gapping up, then it's moving higher, then it's pulling back, and you can see those pullbacks, and eventually it closes at the highs of the day. So that's already a winner. So now if you're buying it on this pullback here, that's a winner. If you buy it on the pullback here, that's a winner. So that's basically the idea of the strategy. Wait for a pullback on a stock that's very, very strong, and wait for a pullback and take a very low risk trade. So in this case, the risk is like on average 10 cents. The stock delivers up more than 80 cents. So that's 8 or 7 to 1. 7 to 1, great. And again, you want to buy 1,000 shares or a $10,000 position or a $20,000 position or a $50,000 position. It's scalable. Remember, guys, we're trading stocks that are over 7 million per day. So there's a lot of liquidity, even though it doesn't show on the chart because we're trading basically the lunch session. So, and overall, the lunch session is not going to be as liquid as the morning session, but the low risk, that's what we are interested in. We are trading in low risk, in a low risk environment, which means we can take advantage of this stock risking only 10 cents on a $1,000 share position. It's basically a winning trade. Okay, guys, hope it was clear enough. Thanks for watching. Do check our mentoring session, and we'll see you in our next video.